Welcome to this explainer. I'm your host, and today we're putting on our skeptical financial market analyst hats. We're going to take a really hard forensic look at some brilliant new insights from Eudemon Consulting. Their research puts forward a rather unsettling hypothesis about the modern insurance market. Basically, they argue that the system has structurally divorced revenue generation from risk-bearing. So we're going to map out exactly who gets paid when the market softens, why this is kind of baked into the financial architecture, and most importantly, why the systemic fragility could ultimately impact your very own premiums and portfolios. Okay, let's dive into this. Because, every time an insurance cycle softens, you hear the exact same complaints, right? Carriers are desperately chasing volume, brokers are placing business without caring about long-term pricing sustainability, everyone just blames the soft market. But as Eudemon Consulting sharply points out, these participants aren't being irrational. Actually, they're acting perfectly rationally within their incentive structures. The real culprit here isn't the current cycle, it's a fundamentally misaligned incentive architecture that rewards immediate revenue while totally ignoring long-term balance sheet destruction. To set the macro context here, take a look at this stark data point from Q1 2026. Property catastrophe reinsurance rates dropped a massive 14% year to date following the April renewals. That's the sharpest decline we've seen since 2014. And at the exact same time, global commercial rates dropped 5%. We are undeniably in a softening rate environment for property. But while everyone is hyper-focused on those falling rates, we need to shift our focus to the structural chain operating right beneath them. Because when pricing becomes inadequate, we have to ask, who actually suffers the consequences?
Section 1. Following the money chain, tracing risk and revenue.
To really spot the systemic fragility, we need to conduct a bit of a forensic financial audit. Let's literally follow the money chronologically through the modern insurance value chain. So, a risk is first identified by a retail or wholesale broker. Then, it's underwritten by an MGA, a managing general agent, who's operating under delegated authority from a fronting carrier. Finally, that fronting carrier has transferred most of the underlying risk to the ultimate bag holders, the reinsurers. Now, at every single step of this chain, an economic transaction occurs. Commissions are paid, fees are collected, profits are booked, usually immediately or within that first year. But the ultimate loss development, that arrives years later, on a balance sheet, sitting at the very end of this line. Now, what's really interesting about this slide is the dangerous inverse relationship we've mapped out here. As an analyst, looking at this data just sets off massive alarm bells. Look at the top rows versus the bottom row. The entities closest to the actual underwriting decision, the brokers and the non-risk MGAs, they're driving their revenue through gross written premium commissions and holding exactly zero balance sheet risk. Meanwhile, the reinsurers who are sitting the furthest away with the least visibility into the original risk selection, they are the ones holding the highest tail risk. Literally, the people making the underwriting decisions hold the least risk. Section 2. The non-risk retaining MGA. Zero reserves, massive influence. We're zeroing in on the absolute core of this structural problem now. But before we go any further, Eudemon Consulting makes a vital distinction that we really have to clarify. Not all MGAs are built the same. Risk-retaining MGAs actually share the financial consequences of failure through things like captives or quota shares. They've got real skin in the game. Our critique today is aimed squarely at the non-risk retaining segment. These are entities that earn 15 to 25% commissions on sheer volume and hold absolutely zero statutory insurance reserves. None. Notice the stark difference here between operational damage and actual balance sheet destruction. When a book of business deteriorates, what does the non-risk MGA actually lose? Well, their exposure is purely operational. They might lose their capacity provider or, face some lost commissions. And sure, that's painful, but it's just a revenue risk. The capacity provider, on the other hand, faces a devastating balance sheet risk, actual reserve deterioration. It's kind of like a real estate agent pocketing a massive commission on a house with a crumbling foundation, right? By the time the roof caves in, they've already cashed the check. This means a non-risk MGA can earn massive, unrecoverable profit commissions on long-tail casualty lines that look fantastic in year 1, but absolutely detonate in year 5. The mechanism rewards the appearance of performance, not the substance of it. Section 3. Private equity's fragile engine, the $114 billion machine. So over the last decade, a massive influx of private equity has recognized this fee-heavy, balance sheet-light dynamic, and honestly, they've poured fuel on the fire. Let's look at the sheer numbers. By 2024, the U.S. MGA market ballooned to an astonishing $114 billion in direct premiums. That represents an explosive 20.2% compound annual growth rate over the preceding 5 years. Private equity firms have chased this model relentlessly. And why wouldn't they? An entity that generates high-margin fee income, predictable renewals, and requires virtually no capital reserves is a PE investor's absolute dream. They've just been scooping these up at double-digit EBITDA multiples.
But let's look at this through the lens of a skeptical financial analyst for a second. A private equity investor's real fear here isn't a reserve cliff in 5 years. I mean, they don't even hold the reserves. Their primary fear is what we call capacity fragility. Because data on deteriorating claims is often lagged by a good 12 to 18 months, an MGA can keep writing bad business and pumping up its gross written premium story for a long time before anyone even notices. The nightmare scenario for a PE firm is that this growth story completely unravels right as they're trying to exit, compressing their valuation multiple before they can sell the asset.
And the waters are muddied even further by what we call the fronting carrier fog. There are now about 25 major hybrid fronting carriers out there, writing $28 billion in premium. They retain just a tiny sliver of the risk, maybe 5 to 30%, collect a fee, and just pass the rest on. This essentially inserts up to 3 layers of intermediaries between the original risk selection and the ultimate risk bearer. So reinsurers end up receiving aggregated, delayed information that makes it almost impossible to police underwriting quality in real time. Section 4. The reinsurer's dilemma, the last line of discipline. Moving all the way down to the very end of the money chain, we find the ultimate bag holders, who also just so happen to be the market's final crucial fail-safe. So the crucial point is that reinsurer discipline is currently the market's primary correction mechanism. As Gallagher re-noted in April 2026, while property rates were plunging, casualty reinsurance remained broadly stable. Reinsurers are actually enforcing discipline through attachment points and tightening ceding commissions. And that tightening is the clearest signal of concern about book quality, often visible well before loss ratios shift materially. Right now, they are literally the only ones keeping the whole system honest. But there is a looming existential threat on the horizon. At the end of 2025, there was a record $136 billion of alternative and insurance-linked securities, or ILS, capital just sitting in the market, aggressively seeking yield. This is exactly where our structural analysis flashes a major warning sign. See, much of this alternative capital built its track record in short-tail property catastrophe risk. A hurricane hits, you pay out, and you move on. But now, $1.7 billion of this untested casualty ILS capital is entering the long-tail casualty space. And this is genuinely concerning because they simply do not have the institutional memory for how casualty losses develop over a decade, especially not in an environment with $19 billion in global litigation funding driving up nuclear verdicts. If this naive capital undercuts the traditional reinsurers to win business, it weakens the market's vital discipline right when we need it the most.
Section 5. Will the system break? The ultimate test.
Let's bring this forensic autopsy to its climax. We have originators taking commission without risk and PE firms driving explosive volume. Now look at how this misaligned segment has compounded the systemic risk. And this brilliantly illustrates the point. Non-exclusive MGA market share has skyrocketed from 33% in 2017 to a dominant 57% in 2024. This profoundly misaligned segment has scaled so drastically, meaning the systemic danger is compounding every single day. Can this structural misalignment survive the next cycle when the architecture itself is the problem? Which leaves us with the ultimate question. Has this non-risk retaining segment grown past the point where reinsurer discipline alone can keep it honest? Because if that final fail-safe gives way, the financial consequences for the downstream balance sheets and ultimately the everyday policyholder will be staggering. It's a fascinating and frankly sobering look at the hidden architecture of our financial markets. Thank you for joining me for this explainer. Keep asking the hard questions, and I'll see you next time.